So hopefully right now what you've got is a screen which says fixed income. I think my video is switched off. I'll turn it on in a few minutes. But very much I'm going to talk you for the next 20 minutes through our asset allocation views firstly, and secondly through our fixed income views, and then I'll hand over to Pete. As Neil said in the beginning, please type in questions for Q&A. The truth is we'll only talk about those a little bit later. But for now, let's work through this. So in terms of fixed income and asset allocation, the starting point is that, the starting point for any fixed income discussion these days is what about South Africa? Because South Africa as a country is basically running out of money, or certainly our government is running out of money. And it's probably the number one question I get asked is, what is the direction of South Africa, and how can I invest in bonds in a country that's in our fiscal situation? So I'm going to talk a little bit through South Africa and sort of talk about how we think about it in Anchor. And then from that, we can talk about what that means for asset allocation. But in terms of South Africa, what we see is, I've got it outlined as scenarios, but it's almost like a continuum if you want. And on the one side is the high road. It's the scenario where everything works, we get economic growth going, prosperity follows. On the far opposite end of the spectrum is effectively a failed state. The government runs out of money and we go Zimbabwe, Venezuela, or sort of pick your sort of country, I guess. But those are kind of the two extremes. In between this, though, because it is a continuum, you have other scenarios that we've got to be aware of because there are realistic possible outcomes, and South Africa can move between different sort of points on this continuum over time. And the first is what I've dubbed a road to nowhere. And this is a situation that will arise if South Africa is able to kind of get enough revenue going, reduce its national expenditure, get the economy growing slowly, and we find ourselves in a country where it just bumbles along. It doesn't really get any better. It doesn't really get any worse. This is a very plausible scenario. And in fact, many African countries have sort of found themselves in this situation. And I talk primarily East Africa. It's a sort of Kenyan, Tanzanian type scenario of an economy that just bumbles along and the status quo is maintained. The other scenario we've got to be aware of is one where we bumble along, but the government expenditure eventually exceeds revenue, and the government is forced into a sort of bailout, into approaching agencies for help. And at that point in time, the help typically comes in the form of financial assistance, along with policy corrections. Commonly dubbed the IMF, not that the IMF is the only bailout institution. The Chinese might help, the Russians could get involved. There are a number of different combinations. However, we've got to, from my perspective, what we're saying is there is a chance of a bailout type scenario that we can't take off the table. So those are really the sort of scenarios that we think about here at Anchor. In that regard, for each of the scenarios, they've got different watch points. For the high road, what do we really want to see? We need to see that the government regains the trust of the population. It regains the trust of the private sector for private sector investment and private sector growth. We need to see pro-growth policies, and we need to see SAE reform. No surprises. But the road to nowhere, the sort of bumble along scenario, what you really see is that the developmental state ideals trump reality. What that means is that the idea that the government can drive economic growth, that the government should drive investment continues. We see that government expenditure comes under control to a degree sufficient to allow them to just maintain the status quo. And to do that, we need to see slowed corruption. For the bailout scenario to then come into effect, if we look at a slightly worse outcome, what you see is over time, it's relatively stable, but state-owned enterprises, SAA is a prime example, and grants to the unemployed drain the fiscus. We see a lot of comments on UIF at the moment where the government's saying, look, it's not an infinite pot of money. We talk about corruption that then remains endemic. So basically, the corruption means that the theft from the government is at such a pace that we can't afford it. And ultimately, when the government runs out of money, it needs to make a decision to go and seek a bailout. So that's what we look for as watch points for that scenario. The final scenario is a failed state, and this is typically going to take place where populist solutions take preference in the government's eyes rather than looking for help. We talk about solutions like printing money, QE to finance the government. Not a great idea. The Turkish tried it recently. We talk about taking money from pension funds, prescribed assets. I can't think of a single regime that's actually instituted prescribed assets and survived. It tends to be the sort of last gasp for cash for a government. And similarly, we talk about a default on the nation's debt, which again would ultimately lead to a failed state. So those are the scenarios. That's how we think about them. And, those are some of the key watch points. What is interesting for those, though, is that for each scenario, they have vastly different asset allocation requirements. And that's what makes asset management and asset allocation challenging at the moment. All of those scenarios are plausible, and we've got to try and find an asset allocation that actually suits most of them. So in the high road scenario where South Africa's economy takes off, no surprise, you want to buy South African risk assets, South African equities, South African bonds, and you want to reduce your offshore exposure, and you want to reduce multi-asset income, your stable funds. In your road to nowhere scenario, and actually in your bailout scenario as well, what you will find is that you want to buy African income, so you want to buy South African multi-asset income funds, you want to buy bonds, but for your growth assets, you want to look abroad, so you want to buy offshore equity. And that's what the asset allocation becomes in those sorts of scenarios. And then finally, in a failed state, you basically sell everything in South Africa and you buy everything offshore. So that's the sort of fourth scenario asset allocation that we're dealing with. And different people, when we speak to them, actually have different perspectives of where we are and therefore different asset allocation requirements. From our side, trying to look at this impartially, let's look at what's happening in South Africa at the moment. So in terms of pointers for the high road, what makes us think that the high road is possible? We have seen tenders recently for 12,000 megawatts of electricity, renewable energy being tabled. That's a massive, massive step towards fixing the energy insecurity. It's a massive step towards fixing the country. Regrettably, the president is tabling his National Economic Development Program in Parliament tomorrow. We've seen lots of commentary about what might be in there, but the truth is the details have not been published. We need to look at the details of what he's proposing. The rumors I've heard are that this is generally quite positive. The sort of key economists I speak to say they are expecting quite positive developments. What we've seen so far is good, but it comes down to the details, the deadlines, etc. tomorrow. To the extent that we are able to actually put pro-growth policies in place, fantastic. So very excited to see what our president proposes in Parliament tomorrow. And then the government has openly accepted from multiple sort of communications that it no longer has the capacity for infrastructure rollout. It does not have the financial capacity, and its expertise to actually develop infrastructure have also been hollowed out. And it acknowledges this. So from that perspective, there are reasons to be hopeful. The thing is, if I look at the road to nowhere, the prosecution of corruption has started. So corruption should slow down, not necessarily to the extent we need it to slow down. We haven't seen the high-level arrests as of yet. Bailouts continue. SAA bailout continues. The finance minister has said that he is going to talk about that in his medium-term budget speech, penciled in for the 21st, but I see he's trying to delay it by a week. So that, that bailout continues to worry us. We've seen other state-owned enterprises raise their hand for more bailouts again. Most recent was Denel a couple of days ago. The expenditure cuts that have been proposed by the finance ministry, so they said to us in June that we're going to cut expenditure. That looks reasonable. It actually looks achievable. We think he's going to get there. It's not a particularly challenging set of expenditure cuts. So from that perspective, we think that the government can actually rein in its finances to at least put us back on a sustainable path, not necessarily a good path. And the biggest challenge we've got is the policy disconnect. So you've got conflicting policies, conflicting statements from government, and that still needs to be cleaned up. And that's going to take time to actually deal with. However, in terms of bailout, getting ourselves to a bailout, the biggest concern we've got is the continuation of the propping up of state-owned enterprises. But what we also note is that the government has outright rejected a lot of the populist statements out there. They've rejected prescribed assets. They've rejected changing the Reserve Bank mandate. They've stated that they're not going to be nationalizing the Reserve Bank in the near term because, frankly, they'd rather spend the money elsewhere, which makes sense. So from that perspective, we take heart that a lot of the populist activities that could result in a failed state have been taken off the table. So at the moment, there's nothing out there that says, we're going to go down the failed state route, and the government's been very, very careful and deliberate in taking those populist statements off the table. That's not to say that in 5 years' time, things don't change. It's very easy to say that now when the decision isn't really upon you. However, the government communication at this stage is very much sort of concentrated around the other three quadrants. So where does that leave us with regard to asset allocation? It leaves us in the world where what we think is most prudent for the next 12 months is to earn your income in Africa and to look for your growth abroad. So our preferred asset classes are domestic bonds, domestic fixed income, and then global equity as well. Global equity we're showing as neutral on this slide because as people say, arguably it has run a lot. That being said, we do think there is significant upside, and we've tried to take a very conservative stance here, but it is our preferred asset class from a risk perspective. And then local equity, people also touch on. Our perspective is that we're incrementally more bullish, we're incrementally more positive than we have been in the past, but not enough to move it to a sort of positive overweight at this stage. So that sums up our asset allocation in a nutshell. And what I'm now going to do is talk about our fixed income views and then hand over to Peter, who can talk about our equity views and pull it all together for you. Before we do that, regrettably, we had a roadshow in February, and that was my last roadshow in person, actually. I remember, I think the last event was in Johannesburg, and I went around the country standing on the stage, and my job was to talk about our COVID views. At the time, I said that, look, we're looking through COVID. We think it'll blow over, probably not a big event. I got that one wrong. I got that one properly wrong. But as we sit here now, if I look back over the COVID period, your best course of action through the extreme volatility we saw was actually just to sit tight, because asset classes have recovered, and in all probability, you've come through it reasonably all right. As we sit here looking forward, that's the message on COVID as well, is it's going to remain volatile. We are going to see second waves, third waves potentially. We're going to see interesting politics around COVID. We're going to see talks of further shutdowns, but each wave seems to have less and less impact. That's certainly the experience in previous pandemics. And the other experience is that if you are able to take a view of looking through this, it might present you with one or two interesting buying opportunities. But it's not something that's going to completely derail the system at this stage. Coming across to the Rand, Neil had the slide up that said the Rand was at 15 last time I spoke to you. It's now at about 16.50, so it's obviously weakened through COVID. You can see in our chart here, the jagged line is effectively the Rand dollar over time. And you can see how it shot up to a record weak level of, I think it was about 19.10 at the height of the COVID crisis. Against that anchor applies a PPP, purchasing power parity model, and you can see how the PPP model over time is pretty much a flat line. The Rand shot way weaker than our model would suggest, and it's been recovering. We believe that the Rand is likely to continue the recovery trend. The policies that are coming out on the ground in South Africa are probably going to be Rand positive. Equally, we think that the dollar is probably going to find itself in a weaker spate for a period. So from that perspective, we remain of the view that the Rand probably recovers to sort of the high 15s and then bumbles around there for a while, in our view. Coming on to yields, most of my competitors, most people are going out in South Africa and saying South African real yields are attractive. And what they mean by that is if you take the yield on a South African government bond, 9.5%, minus inflation, which is maybe 3.2%, that leaves you with 6.3% as what you're earning above inflation. South African bonds are yielding CPI plus 6.3. If I look across the world, what we've done is charted for you what the real yield is across different countries, both or different emerging markets. Very interesting to note that of the established, mainstay emerging markets, South Africa is the cheapest. Our bonds are still the most attractive. We still think that will attract foreigners into our market. However, we've got to be cognizant that in the scenario where we move into a sort of, weaker environment, bumble along environment, bailouts environment, bonds could get a little bit cheaper, which is kind of us converging with the rest of Africa. That being said, most of the cheapness is probably already done. We see bonds as attractive. We see them as fairly priced. And we do think that South Africa is where you want to invest for yield. So from that perspective, to sum up South African bonds, we think it is going to be volatile. We certainly think volatility is here for a while still. The yield is attractive. We think you've got to hold South African fixed income for yield. They work well in most of the scenarios I outlined above. So from earlier, so from that perspective, they're actually quite attractive, sort of man for all seasons. And we do think there's potential upside. Foreign participation is low, but as volatility globally and risk aversion globally subsides, we think that our bonds are probably going to find further support. So we're quite positive in South African bonds. Hopping across to global bonds, what you see is a chart here of the yield on the US 10-year bond, the jagged line, against Anchor's fair value for the US 10-year yield. And what you've seen through the COVID crisis is risk aversion. People sort of flocked into US interest rates, into US bonds, and that's pushed the bonds to very low yields, certainly versus our fair yield, which is closer to about 1%. US bonds, global bonds are yielding less than that at the moment. So we think that global bonds are expensive by virtue of the volatility we're seeing, by virtue of some of the uncertainties that are definitely still in the market. So from that perspective, we're saying be a little bit cautious on global bonds. But if you've got money offshore, and you're sitting in equities and you just want to take your foot off the gas, it's not a terrible place to be. I don't think you're going to see the risk of massive losses or massive surprises. More than anything else, it's an asset class that'll just bumble along for a period for you. So from that perspective, we think global yields are also going to be volatile, albeit in a slightly narrower range. The yields are very low, so that's saying you've got to accept that if you're investing in global fixed income, you're not going to earn much. It's a safe place for cash that you don't want to put in equities. And as Neil said, we've actually just launched the Anchor BCI Global Income Fund, which is looking to earn dollar interest income for clients who are already abroad, don't want to repatriate the money, but just want to take their foot off the gas on equities for the moment. To summarize the fixed income views, domestic income, where will the money be made? Buy domestic income for its yield. The 10-year bond, which is ranging between about 8.75 and 10% over time, means buy the bonds, be patient, accept you'll see some volatility, but you're going to see great interest income that you aren't going to earn anywhere else. Conversely, global fixed income, avoid duration and hold corporate bonds. We can generate for you between 2 and 3% yields. That should achieve your objectives of just taking risk off the table. And it's not a terrible place to be for clients who are slightly more risk averse offshore.